Hi, and welcome to our latest webinar, How to Spot a Company that is Heading for Failure. Well, external forces are often blamed for the death of a company. The seeds of its demise are always sown long before it hits the final buffers. No company fails overnight. That's just simple. Every famous corporate failure, and even those that you know about further down the pecking order in your own market, were the culmination of several factors that the board of those failed companies just failed to address in time. Now, it's hard not to talk about corporate failure at the minute and not touch on COVID-19 and obviously the current economic crisis. Yes, the pandemic has been once in a lifetime, unprecedented, and all those overused words. And yes, some companies have seen complete decimation of the market, 90% more in terms of reduction in revenue. However, the blunt reality is the majority of companies will survive. More companies will survive COVID-19 and even the Brexit chaos that's probably coming behind that than will actually fail. Now, at Plimsoll, we produce an analytical model that helps you spot warning signs of looming problems in the financial performance of any company, whether it be your own, your competitors, your suppliers, your trading partners. So whether you are looking at your own performance or keeping an eye out for alarms that are starting to sound companies matter to you, every company gets at least 2 years' worth of warning that they need to make changes to ensure their survival. Now, the only companies that will fail as a result of the current climate are those that Plimsoll has already rated as caution or danger. That's just true. They had weaknesses in their financial performance that made them vulnerable to a shock. And to be honest, the virus was merely the pin that popped the bubble. And were it not for COVID-19, something else would have come along further down the track that would have seen them fail, be bought out, or just slowly disappear from the market. Now, we firmly believe that failure can always be avoided if a company acts quickly and makes the hard decisions early. Now, this webinar is designed to show you how to spot the early warning signs of companies heading for trouble. Now, I'll be using a number of famous examples to highlight how boards often ignored warning signs and carried on regardless in some cases, chasing the vanity of growth at the expense of the sanity of profit. Now, 9 out of 10 previously failed businesses were rated as danger by Plimsoll up to 2 years prior to their ultimate demise. So that means that every company that fails had a chance to make those tough decisions that would have kept them afloat, but they completely missed them. So we're going to look at 4 warning signs to look out for as a company starts to fail. Now, one of the first warning signs of a company heading for danger is a fall in sales relative to its assets. Now, this is often true of companies with a declining product cycle or just after they've gone through a rapid expansion. The latter are indulging in overtrading, and they're focusing on size rather than a productive return on the assets and their investments. Now, Jamie's Italian followed this pattern. The company got massive plaudits for its sales growth and putting bums on restaurant seats. It rapidly tried to boost its sales with coupon offers and discounting, but it just didn't work. Relative to its assets, the sales growth wasn't enough. The rate of growth slowed markedly towards the end, and the company became overstretched. Now, other corporate failures, thinking the likes of HMV and other famous retailers, didn't react quickly enough to a rapidly declining product cycle. They had the brand recognition, they had the goodwill of their customers, but they reacted far too late to changes in their market and were left with declining sales, but still the same assets, still the same shops. So whether companies are suffering a declining product cycle or overtrading in an attempt to grow, every business leader's got to be mindful about generating a sufficient return from their assets that they're using. Warning sign 2 is declining profits. Now, the above conditions that we just touched on there often erode the profitability of a business in question. Now, when that's combined with uncontrolled costs, it can result in substantial losses being made. Between 2014 and 2017, the profit return on the total assets at Jamie's Italian fell from a relatively healthy 8% down to a ruinous minus 64%. Trading margins fell due to aggressive pricing promotions, while costs remained stubbornly high, and debts increased to fund the expansion revision as they opened more restaurants, etc. Pretty Green, the fashion brand famously launched by Liam Gallagher, is a stark example of a company that posted a loss in 4 out of 5 years prior to its failure. You know, despite sales growing almost fourfold between 2014 and 2018, it was clearly overtrading, never posted a profit in any of those 4 years. So in both instances, there was ample opportunity around 2014-15 to address the slide and reverse strategic decisions that were rooted more, again, in the vanity of growth than the sanity of profitability. Warning sign 3 is a fall in working capital. As profitability falls in a business, so working capital declines too, and if left unchecked, it can completely be decimated. In both Jamie's Italian and Pretty Green's case, the issue is accelerated as both companies fell into loss. The decline in working capital is often exacerbated by continued expansion in fixed assets, continuing to go for growth, as it were. Rather than more traditional accounting ratios, Plimsoll deducts the long-term debt from current assets. So failing companies have real difficulty maintaining the current assets. And, you know, let's be honest. Does it really matter whether a debt is short-term or long-term? If a company's failing, the liabilities are real, and it often impairs the company's ability to trade their way out of the trouble that they're in. So both Jamie's Italian and Pretty Green both had a major hole in their working capital. Their ability to pay the debts without having to sell fixed assets was severely tested, and ultimately it cost them dearly. And warning sign 4 is an increase in borrowing. The final step on this road to failure is an increase in debt. So instead of tackling the problems of falling sales relative to assets and the resultant squeeze on profitability, a failing company often increases borrowing to maintain a level of working capital. It's an unfortunate analogy, but it's the equivalent of using your credit card to cover for a lack of money at the end of the month. It reduces the profits through additional interest payments and increases the debt levels of the company when it's really inadvisable to do so. It's the worst possible time to be increasing debt. So both Jamie's Italian and Pretty Green saw a decline in the equity through a combination of operating losses and borrowings increasing. Had both companies looked to their shareholders for additional funds rather than institutional lending, then that would have had more of a stabilising effect on the overall financial performance. But the chance to do that was some years past, and certainly wasn't in the year where they ultimately failed because the hole had just got too big. So I'm going to quickly show you a couple of recent episodes from our 30-second analyst series. This covers 2 high-profile corporate failures that we've had recently, and how the Plimsoll analysis warned of looming failure long before anybody knew what a coronavirus was.
Look at a lot of Plimsoll analysis and you'll see pride in the performance. This is not the case at the Casual Dining Company. Sales growth has been declining for 3 years, and whilst efforts were being made to reduce the capital base in line with sales, profitability was low, with losses in each of the last 5 years. As a result, the balance sheet was under pressure, and look at the gearing chart. See how exposed the company was to its lenders. In summary, the company has continuously been run in poor financial health. It's clear from the analysis the owners had no love for this business. No surprise that it failed. What's gone wrong at Intuit Properties? Well, the company has consistently underperformed in terms of sales on investment due to the huge amounts of capital involved. See how previously low profitability started to decline as far back as 2018. Poor working capital has been a long-standing weakness in the business, and as the losses mounted, the company has become increasingly dependent on lenders for funding. In summary, the overall financial health of the company has been low for 5 years. The fundamental flaws in the business model have been exposed by the crisis.
So why is knowing all of this important? It's one of the questions that we get asked time and again. Having a health rating, an early danger warning sign on the companies that matter to you is the key to future success. And that's whether that's your company, your competitors, or even your trading partners. If your own business is in danger, then the sooner you reassess what business you want to be, the better. If a key competitor is showing signs of distress, then there are a couple of key strategic questions. Do you jump in and purchase them as a distressed sale? Do you wait for them to fail and position yourself to take advantage? What will everyone else in the market be thinking? Will somebody get in before you? If it's a trading partner, obviously it's a perfect complement to your credit ratings and what have you, to have a long-term financial health assessment on any company that matters to your own business. So Plimsoll believes that company failure can be avoided. We can't emphasize that enough. The warning signs in every company that has ever failed were there multiple years before the company collapsed. Business leaders just need to decide what type of business they want to be. Now, our graphical assessments and written summaries are designed to make this sort of financial intelligence available to all, not just your financial professionals, your accountants and what have you. And we produce these sorts of studies on over 1,600 different industries in the UK, with every company in each market analysed using the same Plimsoll model. So I'm just going to show you a very quick video of who Plimsoll are, why we do what we do and how we do it. So that's the end of the webinar. What we'd like to do is offer all of you a taster of what Plimsoll can do. So thank you for attending, first and foremost. But what we're going to offer you is a chance to get a free report on any company of your choice in the UK, obviously. And we'd encourage you to just drop us an email to enquiries@plimsoll.uk. And we'll send across a company of your choice, and just to showcase you how Plimsoll analyses companies and how you can spot danger signs for yourself. So thank you for attending, and the very best of luck.